Hey, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And in the past week, we've had quite a bit of volatility. Towards the end of last week, we had rhetoric come out of the White House with regards to expectations of curbing more or uh, putting in place more to reduce China's access to advanced semiconductor chips, largely affecting the one industry that has been leading this market higher, which are semiconductors and anything related to the AI trade, but specifically semiconductors. Were hit pretty hard at the end of last week. And the question to start off this week, which we got some of a response to yesterday, is whether the fear in the markets last week were going to spread into this week, or were we going to see buyers step back in and produce what we would traditionally call a buy the dip opportunity? Now, as we look through the charts, I'll show you why I feel that this is more likely a buy the dip opportunity rather than uh, a place where we're likely going to see the fear continue to spread into this week. But earnings is coming up this week, and we are paying attention to Alphabet and Tesla that report this afternoon. You have quite a few other big names like Coca-Cola, IBM that report later this week, and we'll continue to see how those perform, which will, in my opinion, drive a lot of the sentiment here for markets, especially after the news this weekend of President Biden dropping out of the race for 2024 adds a little bit more uncertainty into how the election will play out with potentially Harris on the ticket. So let's take a look at where the charts stand and what our views are based on it. Now, the S&P 500 has made a pretty significant run here since call it mid-April, that it really largely has been unchecked with the pullback here that we saw towards the end of May. And right now, we've got a bit of a small pullback here of equal size heading into mid-July. Now, we pulled back to this 5,500 level here on the S&P 500, and the question yesterday was, were we going to bounce higher from there or continue moving higher? So far, we've got that bounce yesterday, and we're seeing if this continues going into that for tomorrow. You see the NASDAQ 100 respond similarly, pulling back to this 470 support level here, which also corresponds to the 50-day moving average. So both the S&P 500 and the NASDAQ 100 NASDAQ 100 a support level that we've seen. But however, I think the big news out of this out of last week and going into this week is really kind of how small caps have responded. You see the fact that small caps, despite selling off alongside with the rest of the market on Thursday and Friday, actually didn't even pull back to a major support level, and yesterday roared back, another 2% gain here last week. So what we really have seen is the sheer outperformance that small cap has provided relative to the S&P 500 and the market cap indices. As you can see, we're talking about nearly 9% outperformance of small caps relative to the S&P 500 in under 2 weeks. I don't recall ever seeing a metric that extreme. So what this reflects for me is the fact that the rest of the market that has been we've been talking about the need for the rest of the market to play catch up. And this is exactly what we are seeing. We're seeing the rest of the market play catch up here. And despite the sell-off, despite the fear spreading into last week, that actually has continued going into this week, which is overall a strong positive here for equities. And this is the reason why I believe that we have a buy the dip opportunity rather than this is simply a reason why this is just going to the fear is going to spread into this particular week, is because the improvements that we saw here in the markets last week so far have continued into this week. You have the equal weight S&P 500 also claiming back the new all-time high that it made here last week, continuing that. So we're likely going to see, further improvement overall in terms of just the overall participation here in the In the equity markets, and then we'll also take a look at sector rotation, just the healthy amount of rotation that we're seeing alongside with this move. We saw that the value index has outperformed growth by a significant margin here over the past couple of weeks. This is reflecting that big move we saw here in IWM, reversing a lot of the gains that growth has outperformed value here over the past year. Value has played a significant amount of catch up here in just under 2 weeks' time. Commodities continue to moderate here. We're kind of, if you look at commodities, as you can see over the past 3 months or so, almost 4 months now, we've continued to trade in a slight downward trend after what has been a strong period of outperformance. A strong amount of outperformance here. The equity markets have continued to trend lower here on the commodity markets have continued to trend lower here over the past 4 months. So commodities underperforming, expectation is that underperformance may likely continue as equity and bond markets continue to outperform. If you look at the bond market, the high yield corporate bonds reached a new all-time high recently. This is giving us a risk-on signal from the bond markets, from the riskier end of the yield curve. And breaking out above that 77.5 double top and continue moving higher is a bit of vote of confidence, if you will, from the bond markets for a risk-on environment, which is further evidence as to why I'm in the camp that the sell-off that we saw here last week is a buy the dip opportunity rather than a potential reversal for kind of the AI trade and the semiconductor trade, where things are going to start falling apart from here. If you look at the VIX here, we had this big spike here above 16.5. Last week, we've settled in here yesterday at around just below 15. So we've kind of had this huge spike in volatility, which is another confirmation of a potential short-term market bottom that we've seen here, is that spike in volatility and the fact that volatility has come down a significant amount between yesterday and today. So we'll continue to monitor that and see where we currently stand. The 10-year yield has moderated a little bit ever since the news of President Biden dropping out of the race. This has added a little bit more uncertainty into the 2024 election, where the markets were at the moment prior to this weekend pricing in a Trump win effectively. The fact that Biden has dropped out has kind of added a little bit more uncertainty back into the markets. Not a whole lot. We're trading back above 4.2% here in terms of the 10-year yield, which means that bonds have sold off a little bit. But overall, not a huge change here from last week with regards to bond yields. As you can see, TLT failing at this double top here, this 94.5 double top so far. We'll see over the next few days whether or not this makes another crack at breaking above 94 and yields tumbling below 4.2% here again on the 10-year yield. The dollar index trading into that 104.70, 105 resistance level, which just happens to be a resistance and 50-day moving average. My expectation is that any further strength here in the US dollar presents a selling opportunity for the US dollar and an opportunity to buy foreign currencies like euro, Japanese yen, Aussie dollar, those types of pairs. Given the strength that we've seen here out of the dollar, I expect that strength will likely start to fade as we get into that 104.70, 105 resistance level. Looking at gold made a crack at that 2450 all-time high towards the middle of last week. We've kind of traded now below that level here. We're just shy of that 50-day moving average, which is coming in 2370. This does present, in my opinion, another potential buying opportunity for gold investors as we kind of pull back to this 50-day moving average and making a new crack at that 2450 and potentially back to new all-time highs for gold. We have also seen oil drop quite a bit on the back of what looks like a reduction in tensions in the Middle East, even though it might not necessarily feel that way. Markets are certainly pricing in markets are certainly pricing in more calm here in the Middle East. As you can see, we've pulled back to the $78 support level. And we are starting to get to levels where I do think that you can start to see a potential bounce here in oil prices as we kind of continue to trade lower into that $78 level here. We've reached as high as 84, 84 and a half, pulled back to 80, I'm sorry, 78. And I think that now is a potential opportunity to look for a little bit more of a bounce here for oil. And then if we look at the overall sectors, and then if we look at the overall sectors, technology is really the sector that got hit the hardest. You've got that big move here back to that support level. A bit of bounce here yesterday, but overall, as you can see, the significant underperformance relative to the S&P 500 is in the technology sector. Now, this is the sector rotation that we've been looking for months and months and months. We've been talking about the fact that technology has been leading the markets higher for this past year, outperforming the relative markets. And what we've seen here is a stark reversal here in the last 2 weeks. A reversal of such magnitude that we've never seen such large rotation in such a short amount of time, where funds were pulled out of the leading sectors like technology and discretionary into the rest of the sectors that have been lagging behind since over the last 6 or 7 months. So technology has seen underperformance here. Consumer discretionary showing a little bit of underperformance here as well. Communications showing a little bit of underperformance here. And then what we've seen here is kind of a resurgence into all the sectors that have been lagging behind. Financials, consumer staples, as you can see, showing a little bit of gain here. Healthcare, defensive sectors showing some gains here. You have materials and industrials showing significant gains here. So all of these sectors have, I would say, industrials far more so than materials. Look at real estate, significant move in real estate in just the last couple of weeks in terms of relative performance. And even energy, even though as oil stocks tumble, we've seen energy outperform sectors like technology and utilities. So this is the big sector rotation that we've been looking for, and it actually has continued going into the this week, where there was some concern that the fear from last week was going to reverse the broader participation we started to see in markets last week, the rotation that we started to see last week. But what we're actually still continuing to see is that rotation is still continuing. Yesterday it reversed a little bit, but my expectation going into this week is looking for more of that rotation, looking for more of that catch-up play from value-based stocks, looking at small caps outperforming here in this particular market. If that continues to happen, then we have the formation of what is a healthier market rally. We've been looking for this for months. We finally got it. And that's really why, if you look at the broader participation, you look at the better rotation we've seen here over the past couple of weeks, it all speaks to a healthier market rally. You have bonds that are continuing to support a risk-on environment. And for those reasons, I believe at the moment, the sell-off that we got here last week is a buy the dip opportunity rather than an opportunity where that fear will continue to spread and further downside will ensue. So looking at the opportunities here for this week, a couple that I want to bring up. First one, let's take a look at is Alphabet. Alphabet, as you can see, recently pulled back to this 170, 180 support level here. Alphabet obviously reports earnings after the close here today. Certainly in what I would consider the trend following category, where basically you have a fairly significant and clear bullish trend, where now we've seen a bit of a recent pullback here, and that pullback provides that opportunity to take a better risk to reward long exposure here going into the earnings cycle. Alphabet trading at 23.5 times forward earnings, I think, is more than justified given the fact that it's expected to grow EPS at a very, very strong 18%. It's expecting to grow revenues by about 11%, and it has nearly 26% net margins. So very strong margins, strong growth rates, trading at 23.5, which is just a slight bit higher than the average S&P 500 stock, despite significantly better margins and growth expectations versus the rest of the market. Alphabet, in my opinion, downright inexpensive going into earnings, and perspective aligning with what I would consider a bullish thesis going into earnings this afternoon. Another trade I want to point you to is Microsoft. Microsoft obviously taking a bit of a hit after the outage this weekend with CrowdStrike, but also that gives the opportunity of this pullback here to 430 as support. I think this is another buy the dip opportunity on Microsoft, trading at a slightly higher valuation, 32 times forward earnings, but growth rates similarly very strong, 15, 16% EPS and revenue growth rates. Even stronger margins than Alphabet, 36% net margins, and that's why it does trade at a fairly rich valuation of 32 times forward earnings. But that is, in my opinion, still fairly justified given the outlook that Microsoft has with related to the AI trade, and just one of the few companies that are actually this size growing at the rates that they are expected to grow at. Justifies the valuation it's currently trading at, and the technicals provide an opportunity that the risk to reward ratio is favorable to add some long exposure here going into earnings next week for Microsoft. One of the bearish opportunities I want to point out here is Canadian Natural Resources. Now, this is a stock that, as you can see, strong bullish trend, spent a bit of time trading sideways, and then after trading sideways, finally broke down below this $37 support, came all the way back to retest this level twice as resistance, and is now failing at that level. And my expectation is that this potentially can continue moving lower here down to that $33 level. So, chart-wise, looks like this is a classic bullish to bearish trend reversal, potentially targeting that $33 level here to the downside. And then if you look at Canadian Natural Resources, it's trading at about 13 times forward earnings. And this is really where 7% EPS growth versus 0% revenue growth that's expected is really not particularly stellar, especially the revenue growth part of being zero. So any EPS growth that we're expecting here for the next couple of years is effectively only because the company is managing to become more efficient in terms of earnings, not because they've organically have grown the company. Margins are okay at 18%. So trading at 13 times forward earnings for a resource type stock like this is certainly on the richer end of its valuation range. So you have fundamentals that support a little bit more further downside here for Canadian Natural Resources. Another one I want to point you to is Comcast. We've brought up Charter Communications the last couple of weeks. This is a very similar trade setup from what we see here in terms of Charter Communications. Now, Comcast did pull back a little bit here yesterday to this 39.5 support level. That's really kind of the breakout level here. We're seeing if this level holds today, that provides a really strong risk to reward ratio for further upside. Comcast trades at only 9 times forward earnings. It's not expected to grow very much, but it does have decent margins at 12%. So this is really kind of a bargain basement hunting opportunity, to buy a stock that has, has clearly trended lower here for the better part of the past year, but has kind of completed a bit of a bottoming formation, and now has the hallmarks of looking like it's about to break out here, retest, and continue moving higher from here. And it's all about trying to structure these types of higher, riskier trades with the best risk to reward ratio possible. What I mean by that is that if this trade fails, it doesn't have to go much further below 39.5 before you can cut your losses and move on. Relative to the potential upside, I would say your upside target here at the minimum is around $43 or so. So your risk reward ratio is incredibly favorable. to take a flyer on a stock that is clearly out of favor for most investors, but maybe showing some early signs of potential reversal from its bearish trend into back into a bullish trend, and the fundamentals are just downright cheap. So you're not risking a whole lot to the downside given how cheap you're buying this from a valuation perspective. One chart that I also think is worth paying attention to is Applied Materials. Obviously the semiconductor stock, and the question is whether this 215 support level is going to hold. We'll see over the next couple of days if we do see Applied Materials start breaking down below 215. This is one where I do think is worth paying attention to because, while my analysis is suggesting that this is a buy the dip opportunity, I think we always have to plan for the alternative scenario where fear in the semiconductor market continues to spread. Maybe more news comes out. Maybe the White House does move ahead with more aggressive policies to try to prevent China's access to advanced chips. And if that does happen, stocks like ASML and Applied Materials will certainly take a pretty significant hit, which is why I think, given the risk of that happening, trades like this should be on your radar. Specifically, important levels of this particular stock should be on your radar. So if it breaks below 215, I would probably look at potentially adding to some further short exposure here for Applied Materials down into that 185 range as a short-term downside target. It trades at 22 times forward earnings with decent margins, but remember, these kind of equipment manufacturers generally don't trade at very high valuations the same way that NVIDIA does. So while it expects about 11% EPS growth and 7% revenue growth, 22 times forward earnings is actually on the higher end of the valuation range for stocks like Applied Materials. So when things hit the fan, there's certainly, from a valuation perspective, some further downside risks for stocks like Applied Materials. So if things start to get uglier this week, Applied Materials would be one of the trades that I would continue to look at. And then lastly, the last one I'll leave you with is Costco. We brought this up last week. The Costco is just flirting above this 840 support level. And the question is whether this bounces higher or breaks lower. And if you look at the relative performance, right, as you can see, we've already broken lower on the relative performance chart. So from my perspective, I think that there could potentially be further weakness here for stocks like Costco. Breaking below 840 would be a pretty significant blow here for a stock that was $500 stock that's now trading at 900. And the fundamentals is 47 times forward earnings. 47 times forward earnings, in my opinion, is way overvalued for a stock that has thin margins like Costco. For every $1 they earn in revenue, they only earn a little over 2 cents in net profits. You're talking about net margins of 2%, razor thin margins. And then you look at the growth rates, while EPS growth looks decent at 11% EPS growth, revenue growth at about 6%, that's slightly higher than average. There's really nothing to write home about in terms of growth rates that would justify, in my opinion, that 47 times forward earnings. That's nearly 150% higher than the average S&P 500 stock. So this is one that continues to be on my radar. It hasn't cracked that 840 level, but I'm concerned that it will. And when it does, I think that you could potentially see this tumble fairly quickly given the valuations that it's trading at. So with that covers what I wanted to share with you here today. Hopefully this gives you a better understanding of kind of how I'm viewing the risks that we saw here at the end of last week playing out into this week, given kind of the participation and sector rotation that we've started to see. Give you some ideas to start off the week, given that we have a big earnings week coming up this week, an even bigger one next week. So keep your eyes peeled for earnings before and after the close, because that will be a large driver of sentiment over the next few weeks. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here tomorrow.